Morning everybody. Today we are going to discuss about turnover ratios in the ratio analysis. Before entering into the discussion, we will discuss about, we will briefing about what is ratio analysis. So ratio analysis mainly is useful to know the financial position of the firm. So with the help of the financial statements in the sense trading account, profit and loss account and balance sheet. So using these things we can say whether the firm's financial position is in the safer side or not, where the drawbacks are there, where the firm so financially sound. Likewise, we can say lot of that means interpretations with the help of the ratio analysis. As we already discussed, we have mainly four concepts, that means the classifications are there in the ratio analysis. Under that, first one, liquidity ratios. Liquidity ratios mainly useful to know the financial status of the company in the short run. The current ratio, quick ratio, absolute quick ratios are there. We have already one video in that particular area. If you come towards the second one, that is the profitability ratios. So profitability ratios in the sense whether the firm is getting the proper profits or not, firm is attaining the proper profits or not, can determine with the help of the profitability ratios. So there also gross profit ratio, net profit ratio, operating ratio, earning per ratio. Likewise, so many ratios are there to support the firms towards the profitability index area. So next, this also we have a separated video. Now that means if you take the third one, solvency ratios are there. Solvency ratios means current ratio shows the impact, that means financial status of the company in the short run, but in the solvency ratios area, company shows how, that means how can the company meet in the long run their financial commitments. So likewise, there also some of the ratios, debt equity ratio is there. Likewise, some ratios are there to support that concepts. In the today's area, we are going to discuss about the that means turnover ratios. Turnover ratios means how effectively the company is, that means using their assets. For example, you can take the stock, how effectively the company is utilizing their stock, how effectively they are collecting their debtors funds, how effectively they are maintaining these turnover activities. We can learn with the help of the turnover ratios. Here mainly for discussing point, we are going to discuss two things. One is stock turnover ratio and another one is debtors turnover ratios. Turnover ratios may be also termed as efficiency ratios or performance ratios or activity ratios. It also indicates the efficiency with which different assets are utilized in the business, that means debtors or otherwise stock, these things. So here under that first one, stock turnover ratio, this is also called as inventory ratio or stock velocity ratio. Inventory means the stock of raw materials, work in progress and finished goods. This ratio is used to measure whether the investment in stock in trade is effectively utilized or not. So this is the formula for that. Stock turnover ratio is equals to cost of goods sold by average inventory of cost. So cost of goods sold is equals to opening stock plus purchases plus desired expenses minus closing stock. Next to that, here this cost of goods sold is equals to another formula, that is sales minus gross profit. Based on the availability of the data, we need to use the formula whichever is suitable. Next here, average stock is equals to opening stock plus closing stock by, we can explain stock turnover ratio or inventory turnover ratio with the help of the following illustration. Look at here, from the following information, you are required to calculate stock turnover ratio. Opening stock 30,000, purchases 1,10,000, direct expenses 10,000, gross profit 75,000, gross sales 2,20,000, sales return 10,000, closing stock 15,000. So look at here. First, what is the formula here? Stock turnover ratio is equals to cost of goods sold by average inventory. So stock turnover turnover ratio is equals to cost of goods sold by average inventory. So firstly we will see the cost of goods sold. Cost of goods sold is equals to opening stock plus purchases plus direct expenses minus closing stock So now we will substitute values here. So here opening stock 30,000, that is equals to 30,000 plus 1,10,000 plus 10,000 minus 15,000, that is equals to rupees 1,35,000. Now we will see average inventory. Average inventory is equals to opening stock plus closing stock by 2. So opening stock 30,000, closing stock 50,000. That means 30,000 plus closing stock 15,000 by 2, that is equals to 22,500. Now stock turnover ratio is equals to cost of goods 1,35,000 by average inventory 22,500, that is equals to 6 times. This is the method we need to calculate stock turnover ratio. Debtors turnover ratio is also termed as receivable receivables turnover ratio or debtors velocity. Receivables and debtors represent the uncollection portion of credit sales. Debtors velocity indicates the number of times the receivables are turned on in business during a particular period. So here, if we want to calculate the debtors turnover ratio, we should use this formula. Debtors turnover ratio is equals to net credit sales by average receivables or average account receivables, whatever it may be. So net credit sales is equals to total sales minus cash sales minus sales returns. Next, account receivables is equals to sundry debtors or trade bills are receivable. Average account receivables is equals to opening balances plus closing balances by 2. If opening and closing receivables and credit sales are not available, debtors turnover ratio can be calculated with the help of total sales by account receivable. We can explain debtors turnover ratio with the help of the following illustration. Calculate debtors turnover ratio from the following data. Particular amount. Sundry debtors here 1/1/2002. Sundry debtors 31/12/2000. That means this is the opening, this is the closing balance. Bills receivables 1/1 opening. Bill, that means bills receivables 31/12 closing. Likewise, we need to divide which is opening and which is closing on the basis of the dates. Total sales 1 lakh rupees. Sales return 20,000 rupees. Cash sales 1 lakh rupees. Sorry, total sales 7 lakh rupees. This is the 7 lakh. This is the given data. We will do problem. So here formula is debtors turnover ratio. Turnover ratio is equals to net credit sales by average debtors. First we will see the net credit sales. Net credit sales is equals to total sales minus cash sales minus sales returns. Sales, that is equals to, so 7 lakhs minus 1 lakh minus 20,000, that is equals to rupees 5 lakh 80,000. Next here average debtors is equals to opening receivables plus closing receivables by 2, that is equals to 70,000 plus 20,000 plus 90,000 plus 30,000 by 2, that is equals to 1 lakh 5,000. So here debtors turnover ratio is equals to 5,80,000 by 1,05,000, that is equals to 5.52 times. Hi students, likewise we need to calculate the stock turnover ratio and the debtors turnover ratio. So you should do some of the practices with the help of some other illustrations and get clear cut knowledge on it. Thank you.